Good afternoon. Thanks for tuning in. You're watching Countdown on BloombergQuint Live, India's first digital live streaming business news service. I'm Navneet Saluja D'Souza. Well, these are the top headlines that we're tracking at this hour. Markets are holding on to gains on the weekly options expiry day. Banking stocks and broader markets are outperforming. Larsen & Toubro is among the top Nifty gainers after their third quarter earnings and commentary on maintaining guidance. Oil marketing companies too are gaining in trade today after an overnight drop in crude oil prices. Indian Oil Corporation snaps a 7-day losing streak. And Chinese authorities have reported 8 more deaths from the coronavirus outbreak. The city of Wuhan has been put under a lockdown. Good afternoon. We had some relief, at least for the equities, after 4 days of sell-off. We are sustaining the gains, at least.
Yeah, and despite Asia not doing well because of this headline that you just mentioned, Amit. So Asia is having a bit of a cloud, but Indian markets seem to be doing okay. We've recovered a little bit from these levels, and I think the banks played a part here, because if you pull up the Nifty bank chart, you will see that around these levels is where the bank Nifty too started moving up. Look at that. Around from these levels, I think the bank Nifty started moving up and took the markets up along with it. So about 1% higher for the bank Nifty as well. The market breadth, yes, is positive. After a couple of days of a slightly iffy market breadth, we have had a start and the continuation of the day, which has been positive. Bring up the heat map and show you what's happening on the index first and specific movers. So maybe start with the losers, since there are a lot of gainers. So Z under cloud today, 6.5. It went up 2 days despite the numbers looking iffy. So maybe this was due to happen and it's now happening. UPL down about 2.5. Bajaj Finance about 1.5%. So that's that big, strong stock which has corrected a bit. And select names like TCS have corrected a little bit. But a lot of gainers. Yes Bank notwithstanding, which is up about 6%. There's strength in the OMCs today. So IOC and BPCL up about 5.5 and 2.5 respectively. Larsen & Toubro has a post-earnings reaction. Maybe the markets likes the confidence which L&T is displayed in order inflow as well as execution guidance, order inflow guidance, that is. Mahindra & Mahindra 2% higher. There is strength in SBI and Axis Bank as well, surprisingly in Axis too. And Bharti Airtel continues to rise and shine, as does HCL Tech, which is up about 1%. So IT is having a bit of a mixed day, but well, maybe old economy seems to be doing well, because IOC, BPCL, M&M, L&T, NTPC and the likes, all of which are up and amongst the top gainers today. Devina, mixed bag for IT, but no such thing for the mid caps and the small caps. I think the going is good.
It's great, in fact, today. There's a very stark outperformance. If you see the Nifty Mid Cap 100, I think it's up about 1.5%. More small cap index closer to 1%. So everything's looking good across the board from the broader market standpoint, at least. Individual stocks on the back of results that have come in good have done really well. AU Small Finance Bank, first up, is up 10%, was up 6% in the morning. Really strong set of numbers. The stock is rewarded equally. Credit Access Group, though started off lower, is trading flat to marginally higher. And Canara Bank, while the NII seemed to have dipped, profit figures were higher, asset quality was under control. The stock is doing okay for itself. It's flat with a slight marginal positive. Other gainers in trade include the likes of Indiabulls Housing Finance, that's up about 6.5%, so 314 now on the stock. Vodafone Idea 2 days in a row has seen has decent enough gains, so 6% in today's session. And Granules India, post its numbers, has been on an uptrend ever since, post the buyback announcement as well. So today's session also has got gains of about 5%. Stocks that are buzzing in the back of volume. Piramal Enterprises is trading higher by 5% on the back of volumes, which are 15 times the last 20 days average. Godrej Properties seen this big move. You may be talking about the launch of Godrej RK Studio, and therefore there's some amount of excitement and buzz around the stock, and that trades with volumes 24 times the last 20 days average. And then you've got a Dishman Carbogen as well. Losers in trade. You've got most of your PSU names which are on the downside. So you've got an NHPC, Cochin Shipyard, NMDC, all of them under by about 2.5 to 4.5% apiece. And few stocks which are trading in and around their 52-week highs. We've got Tata Global Beverages, that's just about 0.5% away from its 52-week high. Apollo Hospital and Gujarat Gas, all of these names at the cusp of their 52-week highs. But also important to keep an eye out on what's happening in the futures and options space. Navneet is joining us to tell us that. Navneet, good afternoon.
Good afternoon, Davina, and thanks for that. Looking at the futures and options market, the Nifty Futures, as of now, remember, we've corrected nearly about 300 points in the last 4 days. No major build-up had come about. In fact, it was more of unwinding of positions, and that continues even on the upside now. The recovery of almost 50 to 60 points, you're not seeing any major build up coming in for the Nifty Futures. Remember, banking stocks have been in focus, and among that, especially the private banks, since the time the earnings have started to kick in. So there were a lot of shorts coming about on the bank Nifty Futures. We've recovered 1%, trading around the level of 31,000, and open interest too has risen there. So 10 to 11% higher when it comes to bank Nifty Futures. Some cool off, some respite coming in from the volatility index after rising about 15% so far in this week. It's now trading at levels of 16, but at least we've not seen any increase coming in today's trade. On the options front, it is the weekly options expiry, so what levels to watch? 12,200 call continues to witness a lot of OI addition, so riding to the tune of 34 lakh shares. Remember, this is also the level where 20 DMA is placed, and while on the put side, you've got the 12,100 put, which has seen aggressive riding. Of course, the premiums are down because of time decay as the expiry takes place today, so the range remains the same, 12,100 to 12,200. On the stock futures, what a move Ramco Cements has had today. It's at 52-week high, long positions on the futures side, and the stocks also gained, in fact, in terms of the volumes that you're seeing on your screen. And the other stocks which are buzzing today are the likes of India Bulls Housing. It's the top F&O gainer. It's also crossed the 100 DMA. And lastly, some volatile moves coming back into Z, which was up about 5% in yesterday's trade. Now it's slipped below the 150 DMA, one of the top Nifty losers as well. Clear signs of fresh shorting. It's at day's low with cuts of 6 to 6.5%.
There's some important updates on your screen. While Westlife numbers came out some time ago, but look at the updates given by the oil minister, Mehta Pradhan. This has come on Bloomberg, and he's saying that he doesn't think that the telecom liability lies on companies like GAIL and Oil India. These stocks have reacted a little bit further in the session today. I think Oil India too would move up. There were a couple of other companies on which there was talk of some of these liability, but principally on GAIL, when the amount was 1.23 lakh crores or thereabouts that they had, I think, TRA had asked for. Now the oil minister's clarifications, seeming clarifications, would make these companies breathe a sigh of relief. So do watch out for that one. And just mark Westlife as well, because of the numbers that came out. We were flashing on your screen just a minute ago. 5% higher after a very 6% higher after a very strong set of numbers. But before we get into our guests, a very important global market voice. Boom and bust cycles won't stop. That's the word coming from James Gorman of Morgan Stanley. He was speaking to Tom Keene and Jonathan Ferro at the World Economic Forum in Davos, and Gorman said that Fed's actions are only meant to instill confidence in the markets.
There's a reason we've had cycles going back thousands of years, and I don't think that stops. We happen to be in a very benign period with relatively global stability and relatively strong economic growth around the world. Not spectacular, obviously. Europe's slower than the US, but for, geopolitically, this isn't a bad decade. But no, I think. I don't think the cycles are done.
I want to get to the nuts and bolts of your bank, your operations, your strategy in a moment. I also want your view on the Federal Reserve too. The balance sheet expansion. Is it QE or is it not QE? That debate is raging on Wall Street at the moment. What is James Gorman's call on that? What is it?
Well, the Fed only has two real tools that they're working with at the moment, and they've pretty much exhausted the rates. So that's the reality. So they've only got the balance sheet that they're working with, and it is a form of QE. I mean, it has been subsidizing prices. It's been helping the markets along, and they've done it for good reason. I mean, when they raised rates, what was it, 12, 14 months ago, the markets took a scare. So I think the Fed is just bringing things back in line.
What are the implications of that at the moment if the Fed keeps saying it's not QE, but many people, including yourself, believe it is? Neil Kashkari, the Minneapolis Fed, is getting his head around it. He doesn't understand why people are calling it QE. You're taking a risk-free asset reserves and transferring it for another risk-free asset, T-bills. No duration involved, no risk involved. How is it QE? That's what Neil Kashkari is asking.
The Fed's providing liquidity to the market, right? They're providing an underpinning to say, we're here. That's basically the message. It's a message of confidence as much as it is of activity.
All right, and we continue to get you important voices from Davos through the course of the show. Let's also welcome in a market voice, Anil Sarin, CIO at Centrum PMS, is joining us right now on the show. Anil, thanks very much for taking out the time. Let's get in your assessment of what we're doing in terms of the market cycle right now and whether or not it's a good opportunity to make investments.
Sure. Happy to be here.
Right. Talk to us about your assessment of the current market mood and whether or not you recommend any fresh investments to be made at these levels.
So clearly, I mean, only a few days before the budget goes off, this is not the time to be very aggressive or to be very, very conservative. So at Centrum, we would like to be, adopting a wait and watch attitude at least till such time as the budget comes out. But on a longer term basis, I think, clearly the flows into the equity markets in India continue to remain strong. So, and there is a feeling that there is a bottoming that has happened as far as the economy is concerned. A lot of steps are being taken by the government across the board. So those are going to start reflecting themselves in an improvement in the economy. So as such, equity remains an attractive asset class, and we are medium-term positive on that.
Anil, good afternoon. Neeraj here. Just wondering, the portfolio management schemes in 2019 largely benefited by betting on the top tier names. Are you changing that strategy a bit, and are you looking at value, or are you still continuing to betting on growth?
So I would say 2019 was not even growth. It was more of quality which was driving, and it's so well known that just those 15, 20 top names were carrying all the burden of the market, and all the returns were coming over there. But as we look forward into the year 2020, we can't help but notice the extreme disparity in valuations. The Nifty 50 is trading 2 sigma above its mean for the last 16 years. It is trading 2 standard deviations above the mean. Against that, the Nifty Mid-Cap 100 is trading somewhere close to the average. So there is a disparity over there, which would suggest that some money has to move out from the A group and start moving into the B group. That is point number 1. Point number 2 is that in terms of trading turnover also, today what one is seeing is that the A group on average is accounting for 90% of the daily trading turnover, and the B group is barely around 7% of the daily trading turnover. This kind of polarization of trading volumes we last saw in early 2000, in the depth of a bear market where there was a lot of fear. So this kind of polarization we last saw around 20 years ago. So there is not much scope for trading turnover to further concentrate itself into the A group, and it would seem logical that a little bit of movement towards the B group would start happening. The last point, of course, is in terms of earnings. So if one takes on the aggregate, the Nifty earnings are flattish for the last 2-3 quarters. There has not been much of growth as far as the EPS is concerned of the Nifty companies taken as a whole. On the other hand, if you take Nifty mid-cap companies, last 3 quarters they have shown very strong growth, albeit on a base which was weak. But on that weak base, YOY basis, year-over-year basis, for the last 3 quarters, the 3rd quarter ending in September, that is, there has been very strong movement as far as the EPS growth is concerned, and we will see how the December quarter results pan out. But so you have a situation where the valuations they have corrected quite a bit for the small caps, but they are quite strong for the A group large caps. And within the large caps also, there is a lot of narrowness in the leadership. The top 10 out of the top 50 Nifty stocks are accumulating most of the gains. So keeping all of these things in mind, 2020 we are cautiously optimistic about the B group, about mid caps and about small caps.
Anil, what would your assessment of the EPS growth be for 2020? And then if you have to put a target to the index, what would that be if you do put a target indeed?
So honestly, Devina, I don't have off the top of my head what numbers are, but broadly what is happening is most of the PSU banks are seeing a smart snapback because last year was a period, fiscal 19 was a period where a lot of bad loan accounting was being done, provisioning was being done, so the numbers were really bad. So on a YOY basis, PSU banks are showing very good EPS growth, purely because of the fact that this year the provisioning is materially lower compared to the heavy amount of provisioning that was done during the previous year. So on a comparative basis, even though the top line may not be moving so much, even though the NIIs or the profits may not be moving so much, but post-provisioning profits are showing very strong growth. Now, most of the PSU banks are included in the mid-cap index, or none of them are large caps apart from SBI. So for that reason, and of course a few other reasons as well, but by and large I would say it is the PSU bank revival in the EPS thanks to much lower incremental provisioning, which is giving a boost to the EPS growth in the mid-cap domain. So that is causing some kind of a disparity, even though the economic gloom is there all around us. But on a declared profit basis, of course, the other benefit is of course coming from the reduction in the corporate tax rate. So put all of this together, you see this kind of a smart move as far as the mid-cap EPS is concerned, and relatively modest movement as far as the A group or the Nifty is concerned.
All right, while we await what the EPS growth will be, at least in the last 3 to 4 years, we've not been able to get that high double-digit growth coming in for Nifty at least. But talking about earnings, you've got the numbers of PVR flashing there on your screen. Top line, it's a downtake. Net profits are down, by the way, 34%. It's coming at 36. It's way below what the Bloomberg estimate was throwing about. Revenues are down about 915 is the revenue number, what I can see. It's the consolidated number, what I'm reading from the release they've given it. I think the finance cost has gone up significantly higher for the quarter, 122 crore versus 37 crore, which was there in the corresponding quarter. Even if you look at the September quarter, finance cost was 111. So I think that may have impacted the bottom line growth this time around. But in terms of operating performance, EBITDA is showing an uptick of about 87%. And PVR stock futures were quite active, I guess, right from the word go in the morning. There was a lot of build up, but the stock's not reacting too much. It did initially react post the numbers. Right now, it's just about trading flat. We'll get you more finding. Anything else, Neeraj, you're seeing?
Well, just the depreciation and amortization as well, compared to the kind of uptick that they've seen in revenues on a YOY basis. Depreciation numbers of 51 crores for the quarter gone, like a comparable quarter. It's at 134 crores. So that's one more aspect that might have impacted, even though the other expenses have come off quite rapidly. Yep. I think depreciation too has inched up quite dramatically.
Yep, that's PVR for you. And remember, so far for the quarter, most of the brokerages were highlighting due to lower ad revenue growth, which we've seen in the case of Z. Exhibitors like PVR and Inox were supposed to put up a good show, but PVR for the time being is just about trading flat. Anil, any thoughts on the media space? We've got Z earnings coming, we've got PVR today, and there's been disappointment, I guess, so far.
So obviously the first thing that that brand managers cut when faced with a demand slowdown is the discretionary spending, which is the advertising. So it is to be expected. I mean, if there is a retrenchment by the consumers, there is going to be cost-cutting pressure on the brand managers, and the easiest place to go and cut is in the advertising and brand promotion, which is what you are seeing. But with regard to PVR, I think you should be aware of this, that there is this accounting standard 116, which has come into force from this fiscal year onwards. So you will see again and again, it has the effect, especially in those companies which have a high amount of leasing, which is true in the case of PVR. They don't own the cinema hall property, they lease the cinema hall property. So what this accounting standard 116 has done is, it has artificially enhanced the EBITDA, and that rent expense is now actually taken somewhere at the interest level, at the depreciation level. So you will find an unnatural increase in the EBITDA and an equally, or sometimes more than equally, unnatural increase in depreciation and interest. So this is due to the recent changes in the accounting norms. So one will have to look through all of this and then focus on the top line and the core profitability, adjust for the rent, and thereby come to a better understanding of what has happened at PVR.
Okay. Anil, do you have a take on real estate now ahead of budget that also gets more prominence, a lot more active? We've seen a lot of these stocks getting extreme amount of interest. I'm just throwing names right now because these are the stocks that have been active. So likes of prestigious states, you necessarily don't have to talk individually about stocks, but just the sector as a whole and what the government has done so far in order to make sure that the supply stream remains constant, but whether or not that's enough to spur demand is a question.
Yeah, so you know, what is happening in real estate is something very interesting. It's not that the overall demand is going up, far from it. In fact, some respected analysts in the space say that 8 out of 10 developers which are there today will not exist in the next couple of years. So there is a lot of pain in the system. Despite that, the listed players are seeing you know, a great run. In fact, over the last year, if you see, if there is one sector which has rewarded shareholders, it is the real estate sector. So what is the reason behind this apparent schizophrenic behavior where the sector is doing badly but the listed stocks are doing very well? I think the reason comes down to this extreme change in the market share. What is happening is that thanks to two regulations, GST as well as RERA, the advantage has shifted from the unorganized players towards the organized players. So what one is seeing is on an incremental, on a going forward basis, while the earlier market share of all the listed players put together in terms of volume in the residential segment of real estate, it would have been less than 10%. That is the historical number. But if you look at the future in terms of incremental market share, it is well above 60% because the advantage has shifted so dramatically in favor of the large players who have access to capital, who have access to private equity, who have access to, thanks to their brand, they can access you know, the booking amount from the homeowners who want that residential apartment to come. So they have the sales and support and the marketing infrastructure. So the shareholders, so the market has noticed this, and as such, the prices, the valuations of listed players are going up dramatically, even in the face of so much turmoil, so much pain in the sector as a whole. So market is looking ahead and saying that on a going forward basis, you know, the listed real estate players are going to do well because these urbanization and nuclearization of families, where larger families splinter into smaller homes as the family gets bigger and bigger, these two trends are secular multi-decade trends. So people are not going to stop buying houses anytime soon. People are going to move from villages to the towns on a continuing basis over the multiple decades. But who is going to benefit? It is the larger, well-organized people with brands, with access to capital, with execution capacity. So that, I think, is the underlying reason for the performance of real estate companies. You can pick any one of them. And allied to that is the expectation within the budget that there is going to be some support, something to help the sector get out of its doldrums that it finds itself in. So those are the two reasons which are underlying the continuing outperformance of most of the real estate stocks.
Okay, Anil, we'll leave it at that. Thanks much for taking the time out and speaking to us. Appreciate your time today. Let's head over to Mehta, who's standing by in Davos with CP Gurnani of Tech Mahindra.
BloombergQuint. We're coming to you from the World Economic Forum's annual meeting here in Davos. And this morning I have with me CP Gurnani of Tech Mahindra to talk us through the outlook for the IT sector through the course of this year and the big changes that will take place in the course of this decade. Now, Tech Mahindra has not yet announced its earnings, so we're going to have to keep the conversation a little big picture. Mr. Gurnani, thank you so much for joining us. Let me start by asking you this prognosis of slightly slower growth this year globally, and maybe slower growth through the course of this decade. What does that tell you about the kind of demand that India's IT companies will face from clients abroad and the kind of growth trajectory that we'll see unfolding through the course of the next few years?
I'm actually quite upbeat about Indian IT sector, and more importantly, the role company Tech Mahindra would play in the new modern world. And I use the word modern is just to give you an indication that Tech Mahindra has taken bets on 5G, software-defined networks are it's clear indication, and the response that we are getting from the market is that 5G number of trials will increase dramatically through 2020. Many countries you will start seeing the rollouts, but in 2021, 5G will become a fabric on a lot of solutions. I was in one of the panels yesterday on future of mobility. I mean, cities like Delhi and Bombay, I mean, eventually I would like to believe that drones as an individual mode of transport is the future of mobility, but you cannot function a network of drones without a 5G connectivity.
Sure. So telecom is your largest vertical in terms of contributor to revenue. What kind of upside do you expect technologies like 5G to bring to you through the course of this year and maybe even the next few years, 3 to 5 years? Because this is going to be an extensive rollout, and the capex for telecom companies is going to take at least 5 to 7 years, or 3 to 5 years for 5G conservatively.
Again, an off-the-cuff remark, and we were joking between a few of us in the senior leadership of TechM that our parent company Mahindra is called M&M, and for us the biggest opportunity in telecom is M&M, which means modernization and migration.
Okay.
And so what you're seeing out here is that in telecom, the modernization has to take place. Modernization of networks, modernization of the software systems that back you up, and the migration of telcos to becoming a more enterprise-oriented business house. Whether they choose an health tech, or whether they choose a media, or whether they choose a sports, but you would see the telcos starting to do a lot more migration into integrated services.
Impact on revenue?
As I said, we are in a silent period. So
No, I'm talking about you're in a silent period for this quarter, not for this year, next year, and the next 3 years,
so,
right?
Manka, again, we have never given any forecast.
No, impact on revenue from the point of view of, given that this is your biggest vertical, given that this is a big transition that will take place for telecom communication companies across the world, what kind of upside to revenue do you hope this will bring you in percentage terms?
I don't know. We have never given any kind of a future guidance, whether it is for the industry in terms of real numbers. As I said, I do believe telcos around the world are modernizing, and we will have a fair play. It is our biggest sector, and it is also, we are the largest service provider in this segment.
Okay, we'll leave it there. Banking, financial services, many of your peer companies in India have said that things seem a little softer, but Gartner seems to suggest that in fact BFSI spending is going to increase marginally, but this year. So what's your outlook on what that sector will bring you?
You know, for us it is a significant portion of our revenue, but not the biggest.
Yes.
What we are seeing is that in banking and financial services, omni-channel customer experiences, the banks are investing. The banks are modernizing, particularly for their migration to cloud, because banks were slow adopters to cloud. You know, for them, data security and whether cloud is secure or not, it took a much longer period. And number 3 is cyber security. Number 4 is risk management. So I tend to agree with Gartner that the spending in banks will increase, and the reasoning is very simple, is that the customers have become a lot more demanding and choosy, and the banks have to respond with technology.
In both these cases, both in telecom and in BFSI, what kind of deals? Will the deal structures change dramatically? Like, will 5G mean bigger deals for you, longer gestation periods for you? Will the deal structure and therefore the revenue realization change in any fashion?
You know, generic statement here. Generic statement is that most of the customers are now not that keen on a big bang approach. That means, and the digital transformation by itself lends itself to doing agile, accretive development. So I don't see too many large deals,
Okay.
but at the same time, I think it is a series of technology spends and which will propel the market. But wherever there is a large deal, yes, the revenue realization may happen in the same year, but the profit realization comes only in the second and third year.
Both for telecom and BFSI, are you saying this?
Every large deal, because it includes a transformation piece, it takes into account a transition piece.
Sure.
And we as a service provider, if we are doing that large deal, we will have to invest in transition and transformation.
So the incremental orders that will come from, let's say, 5G or from, as you pointed out, I think banks transitioning to a more cloud-based platform, those incremental orders will be large, as you said. Revenue realization in that year, but like you pointed out, the profit will get spread over several years. Now, will you have to invest considerable amounts of money in reskilling your people to be able to look at these new areas of business, or invest in talent differently? And therefore, can you give us an idea of what kind of margin impact these kinds of deals will have?
Most of the larger companies already have taken into account in their portfolio. For example, this is a question of how you manage your yield, and I would like to believe that there is no margin impact, because all of us at any given point of time is doing an X percentage in large deals. That means within the flight we have a few transformation projects happening. So I don't see in future the yield management changing or the portfolio mix changing.
Okay, your operating margins are lower than some of your peers. Is there a plan of action in place on how you expect to be able to boost them and make them more competitive over the course of this year and next?
I mean, I'm sure each shareholder wants us to improve, but I think we will remain. There will obviously be an improvement, but we are not going to be the highest margin, because I am going to balance my growth and operating margin, and I am going to press the pedal harder on growth.
Okay, one final question, a big picture question this is. A few years ago we were very worried about whether Indian IT was losing its edge given the big shift to digital. Now, many companies have been able to get their act together and pitch for large digital deals, and for companies like TCS, Infosys, 40% now of their deal pipeline is digital. Has Indian IT made that transition in a smooth fashion? Do you believe that as an industry we're prepared for what this next 10 years will bring us, or the kind of prominence that we had in the early or the first decade of this millennium, that will slowly fade as the nature of the business changes?
To a large extent, as we enter this decade, you would have noticed that the men and boys are getting separated. You would have also noticed is that many companies like Tech Mahindra chose to invest. 5G continues to be my investment phase. Similarly, you saw many organizations either investing in platforms or investing in creating digital capability
and
or
some
the products.
Right? Like Elixir.
So the direction each company has now taken, there is nothing which is 100% similar. That's the first part. And the second part is those who are not invested have chosen to merge with other companies. So I do believe that the go-go days of 20% growth may not happen, but 8 to 10% growth is sustainable for most of the large Indian IT companies.
Okay, and sorry, I did say that was my final question, but I do have one more. Climate change is a big point of conversation here in Davos, and of course it should be. But I'm wondering if there are business opportunities, right? There are several technology companies talking about, and this is from the industrial point of view, talking about being able to develop technologies that lead industry towards a more carbon neutral fashion. Is there an opportunity for India's IT industry in this transition?
So let's go back. It's not a Y2K.
No, it isn't.
Right?
Course, yes.
While sitting in Davos, we may say the slogan is sustain or perish.
Well,
right?
Yeah.
But
carbon neutrality, people are putting down 10, 20 years down the line, right? And it's a slow process.
That's what I'm trying to say. It's not a Y2K. And so, Menka, there is a business opportunity. The first part of this business opportunity is always in energy management.
Sure, industrial tech, yeah.
Right? And then as you go forward, everything that you do, whether it's an Industry 4.0 or whether you do smart cities or smart grids, I mean, there is an opportunity because sustainability becomes your differentiator. It becomes a platform to measure and improve. Okay. So it is clearly an opportunity, but not as big as Y2K.
All right, Mr. Gurnani, thank you so much for joining us
here
in Davos, and have a good rest of your trip.
Sure, thank you, Venka, thank you.
That's Tech Mahindra with their thoughts. Let's bring in the management of Radico Khaitan though to decode their quarterly numbers. Dilip Banthiya, the CFO of the company, joins us right now on the show to talk about those. Mr. Banthiya, thanks so much for being patient with us today. We had just a couple of interviews that we had to go to before we come to you, but appreciate you holding on to the line. Summarize the quarter for us. The revenue numbers look okay, but gross margins did see a bit of a dip.
Yeah, so good afternoon. Actually, in this period of last quarter from October to December, we have grown on our volume by 14%, where our premium brands have grown by 21% and the regular brands have grown by 11%. So the top line growth has been very well at 17.2%. However, because there is a raw material increase, and in this period, we have seen an increase of around 22% in our ENA prices versus the same quarter last year. So this has been offset because of the price increase. However, we have had the gross margin of 48.4% in Q2, which has improved to 49.7%, 130 basis point improvement sequentially, but there is some dip versus YOY. And mainly because of the ENA price raw material scenario being tough in this year. But we feel that the worst is over from the raw material side because there is a good monsoon and we have seen enough hike in last 2 years. So that will improve in future.
Mr. Banthiya, the belief was that you would, because of your aggressive marketing across states and the expansion distribution for 8 PM Black or MM Vodka or the Jaisalmer Gin, you would show volume growth numbers which would be double digits, maybe even clocking into lower double digit volume growth. What has been the number this time around? How do you expect that to shape up going ahead?
So as rightly that we have actually grown on our premium brands where there is 8 PM Premium Black, the 1965, the Magic Moment, the Morphus. So the whole portfolio of premium brands have grown by 21% in this quarter and 16.3% in 9 months. Whereas our regular brands have also grown 11% in this quarter and 10.6% in the 9 months. So there has been a good growth versus the industry growing by 1.5% and 2.5% in 9 months period. So we have beaten the industry by a big margin and taken bigger market share.
So can you talk to us a little bit more about how you're looking at the revenue mix now with regards to the P&A as well as the popular segments? Is there going to be a change from the last 2 quarters?
Yes, so we have continuously improved our top line IMFL sales from P&A section, and in this quarter the Prestige and above brand forms around 50% of the overall sales of IMFL, where the volume-wise it is around 29.4%, but value-wise it is 50%. So versus this was 28.3% sequentially. So we have improved continuously on our product mix to a better side.
All right, so what is the plan with regards to the increase in distributorship? I mean, last quarter you said that there were some, additional credit, liquidity-related stresses. Do you think all of that is behind?
Yeah, so there is some liquidity. In some of the state corporation, there are delayed payment. And that is the reason that working capital and debt in this quarter has gone up by 41 crores. However, we feel that this is temporary. As the states get their dues from the central government, I think this payment is going to be regularized.
Just one question, sir. In light of higher raw material prices, that's been the case, I guess, now for the last 2 quarters, pardon me. Has there any price hike that you've taken in the recent past?
Yeah, we have taken some price increase in the last couple of quarters. However, the overall weightage is around 1.5%. This has been in the states like Uttar Pradesh, Uttaranchal, Andhra, Rajasthan, Delhi, all these states. And since the raw material prices are much more higher, and it has been on a YOY basis 20% plus, so we are talking to some of the large states in southern India, and let's hope for that we will get some price increases there also in future.
Was there any impact on the earnings due to Andhra Pradesh government cancelling licenses of bars in the last quarter?
So there has been some impact of the industry. However, still there is some 10-15% impact on the volume of that particular state.
And how much revenue do you derive from that state?
Around 7%.
Around 7, and on that there's been an impact of about 10 to 15%.
Yeah, but we have improved on our scale because our product mix is going on very well.
Sure.
Our Morpheus brand, Magic Moment, and Old Admiral Brandy all are doing well in that state. There is a growth we are seeing in the Andhra Pradesh in spite of industry slowdown.
Okay, sir, we leave it on that note. Appreciate you joining us and taking us through your earnings, and all the best for the current quarter as well. That's the management of Radico Khaitan. Well, there's definitely been a blip when it comes to gross margins, which have once again contracted. We did see the same trend in the last quarter as well. But as he's mentioned, the pressures are easing off now, and the stock too has actually recovered from the lower levels, at least from the time the earnings came. You did see some selling pressure, but it's back in the green now at levels of 367. And for the markets also, we're sustaining the gains, 12,170 for Nifty. Let's bring in our next guest on board. Dipan Mehta of Elixir Equities joins us on the show. Hi Dipan, good afternoon. A lot of earnings from the broader markets coming by. We spoke to the management of... Good afternoon. Radico Khaitan, PVR just came out with the numbers. Westlife has posted good same-store sales growth. What are you making of these earnings?
No, I haven't seen these earnings so closely. They've just come out a few minutes ago, so wouldn't want to comment without going much deeper into them. But by and large, I think earnings have been in line with what Street has been expecting, and also I think management commentary is positive. I haven't heard many negative, comments coming in. And although there is a certain pressure on account of recessionary trends in the economy, most managements are hopeful that maybe in a couple of quarters or so, they should be starting to get back to their earlier growth trajectory. And I think Street also is liking the earnings season so far. We have seen the breadth of the market improve significantly. And intuitively, I can say that on announcement of results, we have seen far more stocks rallying on declaration of results than showing a correction. So I think we are seeing a complete kind of a build-up taking place, and looks to be like the revival of the bull market, which we had seen maybe a couple of years ago or so. And only disappointing aspect is the volumes, which I think will eventually get corrected. But by and large, I think it's shaping out to be a good earnings season so far. And one needs to keep in mind that the bad news does tend to come towards the end. But whatever we have seen so far, I think it is supportive.
Right. So where are you placing your bets, Dipan? I mean, with regards to the earnings momentum in 2020, we've also got, aside from that, even from the financial space, we've got commentary from, Rajneesh Kumar at Davos talking about this being the best year for recoveries. Do you feel that it's a good time to be positioned in all of these names?
I think so. I think we're very positive on the financials, and not only just the banks, but also the NBFCs, especially the ones which have survived the kind of crisis which was there in the credit markets. And whichever NBFCs have survived, I think they will be on track to gain market share, to grow stronger. A lot of their funding issues are gradually getting resolved. And I think that once we see revival in key markets for them, that being say auto or real estate, you will see significant improvement in the credit growth as well. So a lot of the financials depend upon the real economy for their growth rates, and that I think is a bit of disappointment at this point of time. But in terms of the question marks that we had about their solvency and about whether they will be able to survive and maintain their business model intact, I think those questions have been answered in the last couple of quarters or so. And as I said, I think strong NBFCs, stronger banks, which have been able to deal with the NPA problems, and more or less most of them have already provided for it, I think they can look forward to good times going ahead. So very positive on the bank NBFC sector. And then I think on the consumption side, we're looking out for better trends, if not actual results, from some of the Indian FMCG companies which have lagged the overall FMCG market, like say a Godrej Consumer or a Imami or a Jyoti Laboratories, maybe even a Britannia. So where I think we have seen laggards in the FMCG space for whatever reason, could be rural demand, could be product specific issues, I think those should see a gradual turnaround from this quarter onwards. So I think these are two buckets which we're looking out for, and looking out for good results to come through. And then there are some stray special situation type of companies, which could be in appliances or could be in e-commerce or something like that.
Dipan, what's your take on housing finance and the recovery happening out there? Because we've heard a lot of positive commentary coming in from, banking honchos talking about the housing finance space no longer being an issue. It's going to become a non-issue going forward, and it's only going to pick up. And even in the results of some of the others, like a Motilal Oswal Financial Services, the housing finance segment actually was the bigger kicker for the earnings.
Yeah, I think housing finance companies are poised to make a comeback. What we saw, the numbers coming from Canfin Homes and even Motilal Oswal, clearly shows that there's a revival in the housing finance companies. And those HFCs which are focused on pure retail loans, I think they are completely out of the woods, and they will see significant credit growth as well. And by and large, they don't have an NPA issue. It was just that overall slowdown in, say, affordable housing or some of their own internal issues with regards to raising of resources was what was holding them back. But now a lot of those have got addressed. I think that credit is flowing far more smoothly to the HFCs, to the NBFCs, and the rates at which they're getting the credit also are quite attractive. They are slightly higher than prior to the ILFS crisis, but nonetheless, I think they are still sustainable. So very positive on the HFC side, and what we like best about HFC is the valuation wise they are available very attractive valuations. The standalone HFCs, the likes of say LIC Housing or PNB or Repco Home Finance or Canfin Homes, I think they are available at very reasonable valuations, and these are businesses which can easily compound over 5-10 years or so, given the kind of demand that is there for housing and housing finance.
Dipan, just one final question. I know you didn't look at these numbers closely, but I'm still sounding it off. Westlife Development developers came out with the same store sales growth of 9.5%. Now, with the current inflation metrics that they are, would you be happy with these numbers? The market seems to be happy with the internals because the reported numbers and the bottom line has also multiplied, as a result of which the stock is up some 12-13%. But same store sales growth of 9.5%, how do you read into that?
I think it's certainly positive, and Westlife has made great progress over the last 3-4 quarters or so. They have revamped their restaurants, and I think the new menu and the kind of coffee bar which they have set up is giving them good traction. And as against the Jubilant Foodworks, if you compare that, Westlife has got more scope to increase its network so far. So from that point of view, from a growth perspective, maybe Westlife may do better. But then I think valuation-wise, Westlife is far more expensive. But by and large, I think the quick service restaurants have been doing well. But it's just that want to be a bit cautious in this segment, given the kind of disruption taking place as far as food aggregators and food delivery companies are concerned. And especially in the case of Jubilant Foodworks, I think a lot of these sales which were taking place through delivery would certainly get impacted by the presence of the likes of Zomato and Swiggy. Maybe not so much for Westlife, but I think that's one complication which is coming into the QSR. And also these companies are not cheap in terms of valuation on any parameter that you compare them to. No doubt, I think they have got good potential, but you want to buy good businesses at reasonable valuation and not at outlandish PE multiples.
That's true. Okay, Dipan, we'll leave it at that. Thanks so much for taking the time out and speaking to us today at BloombergQuint and giving us your thoughts. Appreciate your time. That's the view from Dipan Mehta. Let's get in our technical experts on board as well. Brijesh Singh of StockAxis with us, as is Amar Singh of Angel Broking. Gentlemen, both of you, good afternoon. Thanks so much for joining in. Amar, a good start to the trading day today, and it's looking like it's ending well. What's the trade that you would advocate on either the Nifty or the Nifty Bank?
What we're seeing in Nifty is that since yesterday, what we've seen is that the low has been held. And if we look at Nifty Futures, somewhere around 12,100, and again on the downside, which we had spoken. So 12,100 is a very crucial support zone from where we have witnessed a bounce back. And but again on the upside, Nifty Futures definitely needs to sustain above 12,200, 250 zone, because what is likely to happen is that it will again run into selling pressure, because what we see on the daily charts is that daily charts are clearly showing that Nifty is likely to remain under pressure, or we could see some selling off. However, what the most important level is 12,100 levels, because if that is breached, then the low that was made on 8th January towards 11,970. So there is a possibility that then it could reach the 12,000 mark. So the short-term trend for Nifty, I would say more of sideways with slight negative bias. On the long-term chart, still overall positive. And compared to that, I would say Bank Nifty, what we are seeing is Bank Nifty had moved in oversold territory and bounced back. So we'll have to see whether it sustains, or again higher levels towards 31,200, 250 zone. Again, we'll witness some selling pressure coming in. So it could be more of choppy trading session. But on the downside, Bank Nifty somewhere around 30,700 to 800 is a crucial level of support. Short-term trend for Bank Nifty, I would say, remains slightly bearish. But since it's close to support levels, so that's the reason we are seeing a pullback.
All right. Brijesh, what's your take on the index as well as what would your stocks for the day look like?
Good afternoon, Devina. See, regarding with the Nifty, has been concerned, no doubt, Jan 8 and 9, whether the gap has been formed. Nifty had tried to fill that gap, or I would be saying in coming day might be feeling that at least that some part of that gap has, where the Nifty has touched, and from there we have seen a bounce back. Now, on a shorter-term time frame of the charts, no doubt the oscillator were been trading in the oversold zone, and now we have seen a pullback. So I would be saying that Nifty might be trading in a range of downside 12,000 or say 12,040 on a downside, followed by 12,300 or say 12,350 on the higher side. So this is a broader picture range. Whereas the very short-term time frame has been concerned, I am looking a pullback, and that pullback, when I say that I am looking, at least Nifty might try to cross a level of 12,200 or even try to touch a level of 12,220 on the higher side, where they again, it would be the decisive level whether the Nifty wants to move up or not. But till now, what I am witnessing is that till Nifty trades about 12,100 or say 12,120, this we can assume that this should be your support, and this can be kept as a stop loss, taking a Nifty spot value, and at least Nifty might try to touch 12,200 to 12,220 by in couple of days. Regarding with the stock specific has been concerned, two calls are there, both on the buy side. Number one would be the Voltas. Now the Voltas, after making the rounding bottom formation on the daily time frame of the charts, the trend looks positive with the volume breakouts indicate for the moving up, and it's been hovering towards the 52-week high, which has been somewhere around 725. So somewhere around 715, 714, the stock has been quoting present rate on any dip should be used to go long, with the stop loss of 690, play for the target of 745. And another buy call is from a BPCL. Now the BPCL on a shorter term time frame of the chart, the trend line breakout has been witnessed, which indicates the probability of a pullback. So 468, 467, the stock has been quoting. Present rate can be used to go long, with the strict stop loss of 455, play for the target of 482. Both the call time frame to hold would be 2 to 4 trading session.
Amar, what are your stocks for the afternoon?
Yeah, I would say the first stock to look at is Apollo Hospitals. What we are seeing here is that the stock has broken out of a key consolidation zone on the monthly charts. And if you look at the trend on various time frames, the trend continues to be extremely strong and positive. So this is one stock one can definitely look at. So ideally around 1660 zone is a good level to enter the stock with a stop loss of 1597 and a target of 1740 on the upside. And the second stock to look at is BPCL. What we are seeing here is that this stock is definitely strong on the long-term charts, and what we witnessed is that the stock did correct, consolidated, found strong support, and it has bounced back. So the probability of the stock going higher remains. So anywhere around 465 odd levels, one can look at initiating a long position with a stop loss of 447 and a target of 493 in the short term.
Okay, so those are some top trading ideas coming from our experts. But shifting focus back to the numbers, India Grid Trust is the next company in focus. The company has reported a strong third quarter with revenues, profit, and as well as EBITDA all doubling compared to last year. Let's discuss the quarter gone by then with Shah, who is the CEO of India Grid Trust. Hi, Mr. Shah. Good afternoon to you, and congratulations, by the way, on good set of numbers. Tell us what led to this sort of growth on all the parameters that we are analyzing right now.
Hi, good afternoon. Thanks a lot for having me. I think the key reason why our numbers are doubled is that in quarter two of this financial year, we acquired two large projects on the back of a capital raise, which doubled our market cap as well as our run rate of revenue, EBITDA, and PAT. And this is the first quarter when there is a full impact of the entire acquisition that is realizing. And that's the reason it is doubled in this quarter.
So it's on back of new acquisitions that you've done. I remember one concern, I was reading one of the reports, was that the receivable days were going up. If you could tell us what were the receivable days in the quarter gone by versus the September quarter? Was there any improvement on that front?
Sure. So in this quarter, receivable days have increased by just 6 days. Our receivable days were 90 days in quarter two. Right now it is 96. Usually it's a very minor change in the receivable days, and usually the receivable days follow a cycle, and quarter two and quarter four are usually the peak receivable, or rather the best collections and lowest receivable, and we believe that by quarter four we would catch up with the receivable days to back to 90.
Okay. The street would want to know this, Mr. Shah, as during the quarter, the regulator SEBI has enabled rights issue for InvITs like yours, which looks like a positive regulatory development for a trust. What are your comments on that? And on back of that, can we expect any sort of fundraising to come by in the next financial year?
Sure. So I think, as you rightly picked up, it's a very, very favorable regulation. And over the last 4 quarters, there have been several regulatory changes which are done by SEBI as well as RBI to support InvITs, starting from 70% leverage in quarter four of last year, reducing lot size to 1 lakh from 5 lakh to increase liquidity, and now rights issue. Rights issue per se is a great tool because it enables InvITs to raise capital very efficiently in a transparent manner, provides pricing flexibility, as well as all the existing investors gets right to participate in that capital raise. Considering that InvITs are a platform which are a perpetual growth platform, will keep raising capital and acquiring assets more than a normal company, rights issue is a very, very efficient tool for us, and we see it as a positive development. At the moment, we are not looking at an immediate capital raise. The reason being that we have just raised about 2,500 capital in May this year, which would enable us to grow from 11,000 crores to about 18,000 crores over next year or so. And if at all we see any assets beyond that, we would have to raise capital and we would come back to the market with that.
Harsh, good afternoon and congrats on a good quarter. Just wondering, is this performance sustainable? And if so, would you reckon that some of the aspects that you've guided to could actually improve? For example, I think for FY20, you said that the dividend per unit would be at about 12 odd rupees. Do you think going ahead, the fundamental performance and thereby some of these metrics could change in FY21 for the better?
Yeah, good question. So I think, most of the P&L and balance sheet metrics will go for the better because we are going to acquire more projects, and we have signed exclusive agreement to acquire another 7,500 crores. So that will, as our asset size grows from 11,000 crores to 18,000 crores, certainly the revenue, EBITDA, cash, etc. would grow along with that. Coming to the parameter which you mentioned is the distribution per unit. That is a per unit parameter, and therefore that may not change in the same proportion. And at the end of the day, we would have flexibility to earn more cash, and therefore our ability would increase. However, distribution growth is a decision made by the board as looking at the scenario and the investor expectation. So that is something which we won't be able to comment whether will improve over a period of time. Having said so, all the other parameters would certainly improve.
Okay, so one last question. Could you leave us with some guidance, Harsh, about how FY20 as year could end with, and what kind of rough guesstimate growth projections or growth numbers can one look out for FY21?
Sure. So I think, one is that we have guided the market in the past as well that we have a projection of meeting at 12 rupees a distribution this year, which would mean about 666 crores of distribution coming to investor in FY20. With this quarter being at 3 rupees and 175 crores of distribution, we are on track to achieve that, and we are affirming a guidance for FY20 in Q4. For next year, FY21, at the moment we are maintaining a guidance at 12 rupees a unit, which is 175 crores a quarter and 700 crores of distribution in a year. As and when the developments happens of acquisition of asset, we would come back with a revised guidance.
Okay, Harsh, we'll leave it at that. Keep up the good work. Thanks so much for speaking to us today at BloombergQuint.
Thank you.
Well, one more voice from Davos. Mehta is chatting with the CEO of Nielsen, David Kenny, on consumption trends.
You're watching BloombergQuint. We're coming to you from the World Economic Forum's annual meeting here in Davos, right outside the Congress Center. And this morning I have with me David Kenny, CEO of Nielsen. As you know, Nielsen is the world's most recognized company in measurement of both FMCG as well as media. And today I'm going to focus a little bit on media measurement, especially because Nielsen just released a rather interesting report that gives hope to many of us that actually do survive on a subscription model. And that is to say that readers and consumers of content, whether it's news or entertainment, are willing to pay more for trustworthy sources of content. So let's talk to Mr. Kenny about that. Thanks very much for joining us.
Delighted to be here.
It's an encouraging report, I must say, for journalists like me, and I'm sure producers of content everywhere in the world. What did you think was the most telling bit? The fact that people are willing to pay more for this, or that they believe that they think that if they pay for it, they trust it more?
I think it was more of the latter. We've been very concerned about trust in media. We want to not just measure it, but measure does it help people live their lives and make better decisions. What we found is that there is a declining trust in total, because there's been a lot of fake news and other things that people are worried about. But when they pay for news with high quality, they think it's better. And certainly the willingness to pay subscriptions for news is even higher than for entertainment.
Yes. What I did think was interesting in terms of one or two micro trends, but before I get to that, I'll just put some of the numbers out there for our viewers to understand. So I think Nielsen found that 8 of 10 people engage with the news for about 6 hours a week. That's a third of the engagement with entertainment content, which is about 19 hours a week. 38% of those who consume news said they consume it only if it's free, whereas 37% said they consume it only if it's paid. The numbers are a little lower for entertainment. 23% said that they would consume it only if it's free, whereas the majority said that they sort of subscribe to a mix of free and paid for entertainment content. Now, two things that stood out for me here. One, the big potential for microtransactions in India and China, which is not necessarily the broader trend in the Western world.
No.
So I wanted you to talk about that. And B, we're still talking about very small ticket sizes of payments, right?
Well, we are, and I think that that's the way the economy is working, that consumers can pay as they go. And certainly I think the incredible work that's been done in India by companies like Reliance to make sure that everyone has access is making it easier. So there's low cost of telecommunications, there's easier ways to transact, so people are willing to pay as they see news they need or pay as they see entertainment they need. So it certainly, I think, is going to create an additional economy for the media business in India.
Did the survey give a sense to you that there is a cap to how much people are willing to pay, given that the explosion of free content online is now started sort of receding a little bit. People want to be able to read everything, but they can't pay for everything, and those choices are becoming difficult. And then for media companies or news companies, getting into that wallet is becoming tougher. For instance, I'll tell you, subscribers pay 173 rupees today in India. They would be willing to pay up to 347 for news. That's very little.
Yes, but I think we have to understand the affordability of households. And also, I think the fact that people will share news with each other. I mean, there's a lot of sharing of content, as we've seen in the Netflix subscription data this week as well. So, on one hand, it's little, but on the other hand, it's something. And we continue to see that folks are going to pay for quality. I would also be careful not to just focus on subscriptions. I also think part of what Nielsen's trying to do with measurement, if we measure everything, it makes it easier for the advertiser to use television, print, and digital together. And so I think the advertising side of media is also poised to get much stronger in India as well.
All right, Mr. Kenny, you've been remaking Nielsen over the last 2 years at least. You know, at least on the media side, we're still struggling with online measurement, aren't we?
Well, we are, but we've made big progress in India at Nielsen in terms of being able to use new technologies to understand what's going on the mobile phone and the tablet and the PC, as well as digital to the television. And so I would say these new technologies are being more effective and certainly more scalable. There's a lot of complexity in India. Even in television, there's 900 stations, but I think we're finding a way to get to one media truth across all of that. I would also say in India, it's probably the best market we have that we're going to actually start with digital and come back to traditional, because I think that's going to be the way the consumer consumes media, and we want to bring that integrated measurement from digital back to India in the next year.
Well, maybe start off with digital and then move back to traditional. That's what we at BloombergQuint are trying to do as well. Okay, last 25 or 24 minutes left for the markets to shut shop. Let's try and talk about some key movers in trade. We have Mayuresh Joshi with us. So before I get to the next management, get in Mayuresh's comments on those. Mayuresh, good having you. Thanks for joining in. Clutch of consumption names doing well. We spoke about Westlife. We spoke about Radico Khaitan. The other one is PVR, wherein we've seen a bit of a dip in the EBIT margins. So what did you make of these numbers if you've had a chance to look at them?
I was just on the way. So I think
just on the way, yeah.
So having a look at the numbers, but when you do a comparative check between PVR and Inox, right, because those are the comparables at this point of time, obviously the metrics in terms of the spend per head is far larger for PVR at this point of time. What they're also doing in terms of the gross margins for the F&B business is obviously larger, but that's contracted a tad bit. I mean, that is the commentary that my team was sending across. And the third element obviously is the advertising revenue per screen. Because of the inherent slowdown that we probably witnessed, there is some pressure on that front. Though I think as EBIT contribution, it's not that significant. So the content pipeline becomes extremely critical. The launches that we've got in Jan, in Feb and March, I think they seem pretty plausible for a good show to continue for exhibitors in lieu of what is happening on the OTT platforms at this point of time, because there are accelerated investments on those fronts as well. But the audience is still coming, and average utilization in theaters is anywhere between 30-32, which has been the way in the past as well. But valuations are on a premium. So I think there are a lot of ifs and buts for the sector as a whole.
But do you think this is then an opportunity for Inox? Because that one's doing really well today. It's crossed 405. It had gone down to about 375. From there, it's almost at the high point of the day.
So comparative check, I think Inox is something that we like on a better scale. When you probably talk about the metrics, right? The EBITDA to invested capital is one of the highest. The EBITDA that they reported last quarter was one of the highest. When they talk about the bottom line and the profitability as well, I think it was one of the highest for the industry as a whole. So yeah, I think the metrics are improving for Inox. In terms of key parameters. So I think a comparative check, I think Inox probably stands out. The only factor, Neeraj, Devin and Navneet, is that PVR has a larger presence in the South Indian markets. So if you look at the geographical classification, 44% is the reach for PVR in South India. So if there is a lot of content coming in from South Indian movies, PVR inherently does well. But for the next couple of quarters, I think it's more oriented towards the North and the West.
That's after the acquisition.
Yes.
Yeah.
So SPI would also continue to do well.
Well, speaking of consumption, just clear out the management conversation, Mayuresh, before, and Amar and Brijesh also with us before we talk more ahead. Westlife Development in conversation with us after a very strong quarter.
This is, I would say, a lot of foundation building work that we've done over the last 4 to 5 years. The good news is that it is not one-off, and it's been 18 quarters since we've been able to get positive same-store sales growth. Particularly, what's worked for us particularly is that we've been able to give consumers many, many more reasons to use a McDonald's. For example, if you look at McCafe, which by the way now we have scale with over 220 McCafes, consumers can now use us for breakfast and have a cup of coffee from McCafe. They can use us after lunch, they can use us during snack times, and they can use us after dinner. When you club that with both delivery business, where you have outside food at home, and you look at breakfast, all this start becoming very powerful, and the combination of that has helped us do these 18 quarters of consecutive same-store sales growth. Even if you look at margins, obviously as our average volume has grown, I've always maintained that there is flow through to the bottom line. And in the last 5 years, pretty much every year on an average, we've grown our EBITDA margins by about 130 basis points. This has been quite nice because we laid out our Vision 2022 in 2016, and I'm delighted to say that we are very much on the cusp of being able to deliver that. And yes, we do believe that we will continue this growth trajectory, not necessarily quarterly, but on a yearly basis for sure. And we are very confident of delivering Vision 2022.
Okay, fair enough, Amit. So then I also want to talk just a little about the same-store sales growth. Of course, the highest in 4 quarters, and as you already mentioned, well, 18 straight quarters of positive same-store sales growth. The question really is that are we likely to now start seeing a Westlife Development in around double digits, if not double digits, around 10-12%, say in the foreseeable future?
Well, you know, with same-store sales growth, it's never about double-digit or single-digit, and let me try and give you some context to that. So, for example, if in 2015 we were doing 100 rupees in a restaurant, that same restaurant today is doing 163 rupees. So, a 10% in 2015 would have been 10 rupees of incremental volume, while today it is 16 rupees. So, the point is that as long as in the next year in the same quarter, we retain the 163, and add even 10 rupees to that, which may be 8% or 7%, I think we've made tremendous progress. So the important thing is when you double the average store volume per restaurant, then obviously you cannot expect it to grow at the same pace as it has in the past. Yet our Vision 2022 talks about a 7 to 9% range. And yes, we are really, really happy that even in a very tough environment, we've taken it from 5.6 to 6.7 to about 9.2. So we are quite hopeful that this trajectory continues moving forward as well.
Fair enough, Amit. In your press release, you do mention that there are various cost efficiencies which are in place, which have led to your operating margins expansion. My question then is, to what extent has this been on account of, well, raw materials and input costs? Is that aspect also playing out in favor of Westlife Development, and how are you witnessing, well, you know, input costs in general?
So actually, if you read and if you hear people, food inflation has been quite challenging this year. But yet, despite that, you know, we've been able to grow our gross margins quite nicely. The primary reason for that is that, you know, one, scale allows our suppliers to sell or do more throughput out of the same factory, thereby reducing their fixed cost or spreading that over a larger number of units. Along with that, I must compliment our suppliers for working very hard to have anticipated this inflationary trend that is coming and working hard to mitigate some of these costs. So that, along with the work we've done on product margin improvements through McCafe and certain other product changes that we've made, I think put together, that has really helped us mitigate this pressure from food inflation, and yet at the same time, we've been able to grow our gross margins. So that's really the sort of answer to that particular question.
Okay, then finally a question then, so as far as the fourth quarter is concerned, any numbers that you're working with respect to, well, the number of additions that you want to see in stores? It could be McDonald's or McCafes?
So typically, I mean, you know, every year we add about 25 to 28 new restaurants. and this year will be about that as well. Similarly, we add about 30 to 40 McCafes a year, and we will end this year at that or slightly better. We are also pushing very hard to put EOTF stores, which is our new experience of the future restaurants. So again, the growth on that front will be quite nice. The important thing is that as the margins are getting better, as sales are growing, we are reinvesting all that capital back in the restaurants with either new openings or going back and modernizing some of our older restaurants or implementing things like EOTF. So we feel that we are a brand that has remained very relevant to our consumers, and in fact we are changing the way consumers are using QSR, and including the good food story that we've talked about and the changes we've made to our menu. Obviously all of that continues to reflect. So therefore, on a year-on-year basis, whatever we've talked about with our Vision 2022, I think we are very much on track with that. 7 to 9% same-store sales growth, 400 restaurants by 2022, 350 McCafes, 350-ish delivery hubs, EBITDA margins running at about 13 to 15%, and today it looks closer than ever for delivering the Vision 2022.
Well, that's the management of Westlife Development talking about the quarterly performance, a 4-quarter high in terms of the same-store sales growth. The stock has come off though, but it's still a good 8.5% higher. Also time now to take a look at what dealing rooms are recommending. Darshan Mehta is joining us with his channel checks. Darshan, good afternoon.
Good afternoon, and Jubilant, you spoke about Westlife Development. Look at the move that's also come in on the peer group company, and that is Jubilant Foodworks. It's up almost 3%. And because of the results that Westlife did post, the street is somehow excited on Jubilant Foodworks. It's rallied post the numbers that came out. It's an F&O stock, so the liquidity is much higher, trading at a 52-week high. So on all parameters, Jubilant Foodworks is something that dealers are talking about. The other one is Sun TV. There is a buzz of a corporate announcement that could come in, but on the other parameters also trading close to breaking the 200 DMA on the higher side. Valuations now at par with Z, almost there. Cash rate debt-free company. So Sun TV is another counter in which some of the dealers have started taking positions. They believe a bit of corporate announcement could come in. And SBI is after a while again. SBI, there is accumulation that's happening. Some of the dealing rooms did indicate that some of the larger foreign funds have started accumulating SBI at lower levels.
Okay, we'll watch out for that. Thanks a lot for that, Darshan. So those are a few stocks that you need to watch out for. You haven't spoken about these on the charts. Amar, you want to come in on Westlife as well as Jubilant Foodworks? Do you like either of them?
Yeah, looking at Jubilant Foodworks, what we are seeing is that this stock definitely is on a roll, and we've seen the stock continuously moving up. It did form a base around 1600 odd levels. Currently it's around 1800. And the trend remaining positive, but not at these levels. I would recommend buying. There needs to be some correction in the stock, at least 50-60 points lower. Then one can look at initiating some position. And you talked about the other stock, Westlife. If you look at this particular stock, what we see here is that the stock has been consolidating, and over the last few days we've seen a significant increase in delivery quantity as well. And today also there has been a very sharp up move. And technically, yes, this stock continues to be in an uptrend. It's trading at its multi-year highs. So not at the current levels, but yes, the stock, if it corrects towards 400 odd levels, that's a level of support where the stock could ideally be looked at. But one needs to have a stop loss below 390 levels for an upside target of 445.
By the way, PNB Housing Finance is correcting the Q3 now. We're just talking about how some of the housing finance companies seem to have done well. This one is likely performed below estimates. The net profit is at 237 crores versus 303 crores, so not doing all that well. So do watch out for that. Just before we take in closing strategies, Mayuresh, you want to come in on PNB Housing Finance and the numbers? Do you track this one at all?
Yeah. So I think the numbers are below estimates, at least what the consensus was saying, right? But when you probably do a comparative check, what we did as a stack up before the Canfin home results as well, I think. So we tried to compare Canfin, LIC and PNB Housing. So at least Canfin and PNB fell in that category where the capital adequacy are extremely high for both these companies. The return ratios are high, and at the same time, I think the asset quality pressures are not that evident. So I think LIC housing is close to 1.5 odd percent. Canfin 0.88 as reported this time round, and PNB is very, very close to that. So one needs to look at the granularity in terms of what they have probably performed in terms of both asset quality and in terms of the provisioning and what hit they've probably taken on the bottom line. But assuming the numbers that have come so far, I think Canfin was an outstanding set of numbers. So I think there was no two ways about it. I've liked this stock in the past. I think we've discussed this a few weeks or months back. And I think the story still continues. So I think if they're able to deliver in a tough quarter like this, I think going ahead, my own sense is that even if I assume a book value of around 200, 210 rupees for FY21, I don't mind assigning a 3-time book to it on an FY21 basis as well. So I think there is still potential for a big upside for Canfin Homes in my opinion. And if PNB results are poor as they say, or as they are evidenced in terms of granularity of numbers, I think a lot of focus will shift back to the quality numbers which have come out from Canfin.
In fact, Canfin has had a good run so far this month. I just want to pull up the paint companies. There's sudden spike. Pull up Berger Paints, which is up 2 to 2.5%. Asian Paints too has recovered from the lower levels. Berger Paints is sitting with gains of 2 to 2.5%. Shalimar Paints, even the smaller companies are seeing some buying coming about. Asian, however, has recovered from the lower levels. You've got Kansai, Nerolac, Shalimar. All of them are sitting at high point of the day. Brijesh, any of these companies looking good on the charts? The sudden move that we've seen?
Yeah, I would be suggesting Berger Paint looks good on the chart, compared to the other paint stocks has been concerned. And yesterday or somewhere around, stock made a low of 538, and after that it had moved up. So till stock has been trading above 530 or 535. Short term to medium term is being concerned. The stock might be making or would be trying to touch another 50-week high. So if someone is looking for a short term bet, I would be suggesting keeping a stop loss of 530, present rate of 550, 553. One can play on a long set for the target of 575 to 580.
That's Berger Paints for you. Remember, Asian Paints have already come out with its earnings, and the sort of volume growth they had posted clearly did not disappoint the street amidst the slowdown that we are witnessing. But a few minutes to go for markets to shut shop, so let's get you some closing strategies. Amar, coming to you first. Any BTST or any STBT for tomorrow's session?
Yeah, I would say that one can look at Tata Steel. This is one stock which seems to have bottomed out, and there's a possibility that we could see an upside move towards 490, 497 levels, whereas the stock has got good support coming around 465 odd levels.
Brijesh, your closing strategy?
Navneet, I have 2 calls for the BTST has been concerned. Now, Century Textile, a couple of days back, I was on the show of Darshan with the hot money, and I recommended that stock is eager to touch 595 to 600 odd level because the stock had made a bullish flag pattern. Considering that present rate of 586, one can go on a long side with the stop loss of 578, play for the target of 595 to 600 odd level. And another call would be Petronet. After consolidation, and it has moved up somewhere around 276 or 276 and a half. The stock has been quoting, keeping a stop loss of 273. One can play for the target of 281 to 282.
Okay, that's the closing strategy coming in from our experts. Pull up Z, the volatile move this one has had. Yesterday, it recovered from the lower levels, closed with gains of 5%. Z is sitting at day's low. Mayuresh, is the worst behind after looking at the numbers? Of course, nobody was expecting ad revenue growth to be good for the quarter gone by, but subscription numbers?
Yeah, so the domestic subscription numbers have been very strong. So at 21%, I think they have held on in spite of the new tariff caps, which will probably come through. So I think all operators are probably trying to push through in terms of how they'll probably get over this new tariff caps that have probably got announced. Nobody was expecting a good ad revenue growth. So I think the degrowth that one was expecting was around 12-13% or 15.5% is still acceptable in market conditions like this. Again, I think the management is trying to put forward that related party transactions and the recovery thereof over the next 12 to 24 months is something on the cards. But I think you still need to give it time, because I think the environment is still very, very sluggish at this point of time. And until that improves, I think the overall environment in terms of reported numbers will still remain weak. I think the international numbers were very, very weak as well. I think it was a 17% drop both on ad and the subscription revenues for Z. So I think even if there is significant value in terms of where the stock lies at this point of time, with the potential of a recoup in terms of ad growth coming back to normalization levels, I think I'll still give it time. So I think I'll not rush into the stock.
Not even a valuation bet at current?
I think still wait for time, I think.
Okay.
All right. What about telecom, Mayuresh? Bharti Airtel. Market seems to be liking the fact that if it lands up being a two-player market, Bharti is going to be the dominant, the only properly listed telecom stock. Do you feel like it's a good buy?
So valuations are definitely stretched, Devina, at this point of time. So I think what they've probably done in terms of the AGR dues that is expected to get paid off, right, and whatever comes and goes, right, they still need to get those liabilities off their balance sheet. So the capital raising of $3 billion odd that they are expected to do, I think that's some leeway in terms of at least having some liabilities getting off their balance sheet. So the net debt to EBITDA levels probably far better if you stack that up at this point of time in comparison with the Vodafone idea. What they've also done in terms of holding on to their SMS and RMS share, so the subscriber market share and the revenue market share is still very much held on by Bharti Airtel at this point of time. And as the cash flows will start improving, because as the tariff hikes start coming onto their numbers, I think the ARPU improvement will itself lead to better granularity in terms of the wireless India business. The Africa business is expected to hold on, which probably means that the capex that they need to do for 5G and the accelerated investments related to the same, I think they've done a very constrained way till the first half, 8,000 crores compared to 16,000.
As of now, do you still feel, but this is more like a hope trade because there's nothing substantial to back the kind of valuations that it's gone to?
Exactly. So I think valuations are sky high at this point of time. But as you rightly pointed out, I think there are not too many players in the market at this point. So I think people or players or investors don't have much choice if they want a telecom exposure. So yeah, on a EV/EBITDA basis, I think on the higher scale, but if investors are probably holding on, I think they should probably hold on to this.
Okay. What about a quick trading call on this one? Amar Singh, Bharti Airtel.
Yeah, this is one stock definitely one should look at being on the long side because the stock has breached a crucial resistance zone. Now, if you look at the long-term charts, what we are seeing is that in 2017 it had made a high of 519. So 519, so that has been taken out, and the stock is consistently sustaining above that. So the stock has a potential to rally towards 540, 545 level because earlier in it had made a high of 545 many years back. So trading sustaining above 520, the stock has a potential to gain at least 4-5% in the short term.
Okay, that's Bharti Airtel for you. PNB Housing has fallen about 6 to 7% post the numbers. Let's get a quick review from Shafali Malik, who's standing by. Shafali, what's the key takeaway? Why has the stock fallen?
Well, the numbers look extremely bad on the first cut basis. Profit has fallen down 22%. And one key thing that is quite notable in their earnings is a gross NPA ratio, which has almost doubled to 1.75% versus 0.84% on a sequential basis. And both their AUMs and loan assets also look very weak. AUMs are down 3.5% on a sequential basis. Loan assets are down 2% on a YY basis. I don't have the Q&Q calculations on the loan assets, but the reason for the rise in gross NPAs ratio could be twofold. The rise in the NPAs, of course, and also the lower loan assets, which we know have fallen on a YY basis and perhaps on the Q&Q basis as well. So that could be the reason. In the P&L, the impairment of the financial instruments and write-offs is also higher by almost 30 crores on a sequential basis and almost again more than double, almost 2.5 times on a YY basis. So on the first cut basis, the numbers look extremely bad, and they've had asset quality issues in last 1-2 years, which the management has been time and again coming out and addressing, increasing disclosures, etc. But in this quarter, the asset quality issues again have erupted. So the street may definitely not like it.
Okay, Shefali, thanks so much for putting that into perspective. So now you know why the street is disappointed initially on PNB Housing and might be continued because the asset qualities looked pretty shabby out there. Well, let's start wrapping up the markets because the markets is looking anything but shabby after 3 days of a fall and slightly dismal market breadth. We've actually turned the tables a bit today. So good going despite Asia not looking all that great. Mind you, banks have led the charge today and bouncing back from those key oversold levels on the RSI. And I think the broader markets too have done well, outperforming 1.5% for the mid caps, nearly 1% for the small caps. But let's talk about the large caps first and what's moving and what's not. So you have Yes Bank 6.5%, IOC about 6%, very good going there. Larsen & Toubro, and then GAIL. Some comments from Dharmendra Pradhan about how GAIL may not be liable to pay those dues from TRAI. That helping. M&M, Titan, SBI, Grasim, and Bharti. What a strong stock this one is, up another 2% in the session. Really good moves for the telco. What is not done well? Z down about 7.5%. UPL about 3.5%, 4%. There's some losses for Power Grid. Cipla on back of news corrects a bit. There's some weakness in TCS, Bajaj Auto, and Dr. Reddy's, but that's few and far. The one which matters on the losing side is Z, because that's the only one which is really corrected. On the gaining side, a bunch of stocks doing the rounds. But similar situation at the broader end of the spectrum as well, maybe even more pronounced. Navneet is here to take us through that. Navneet, very strong market breadth too today.
That's right, Neeraj, and a lot of result reactions coming by. Let me begin with the Small Finance Bank putting up a good show for the December quarter. You had AU Small Finance Bank stock, which rallied post good set of numbers. So that one was up about 9 to 10%. And you also had Ujjivan Small Finance Bank. The profits, remember, for both these companies nearly doubled, and this one's also closing with gains of about 4%. We had numbers of Westlife Development, good same-store sales growth. Remember, there's been sequential improvement now, which is coming in the last 2 quarters. I think that's all well for the stock prices as well. So Westlife closing the day with gains of 9%. Pyramid Enterprises, a good response to the rights issue. Probably that's the reason why you saw the stock also moving higher. 4.5% gains coming by. We just addressed the paint companies. Berger Paints, just in the last half an hour or 15-20 minutes of trade, there was some buying interest which came in, and the stock's closing at the highest point of the day. NIT Tech has bounced back today after the profit booking that you were seeing in the last 3 or 4 sessions. Look at that in the last few minutes of trade. NIT Tech is closing with gains of 9%, and you also had a high beta counter like Indiabulls Housing Finance bouncing back in trade, closing at levels of 313. You had losers as well. So PNB Housing, of course, reacting to the numbers, and Shefali just gave us a reason. I think asset quality worsened, and the stock's closing with cuts of 7%. Cochin Shipyard corrected in today's trade. That one's closing with cuts of about nearly 6 to 7%. Cummins Industries and F&O counter did not have a great session. I guess throughout the session it was trading in the negative territory. 2.5% cuts coming in. ITI to raise 1,400 crore via follow-on public offer at 72.77. That's the price band, and that was the reason, because the current price is 93, so it's come at a deep discount. And PVR did not react too much to the numbers. I think there was a bit of disappointment which definitely came by. So the stocks also corrected about 1% to 1.5% there now.
All right, so the last 3 days of that incessant selling that we saw on the index seems to be getting recovered bit by bit. Today's session saw the first day after those 3 days of correction that we saw on the Nifty Bank, which was more severe. Today gained about 300 odd points. Nifty 50, making its dash towards 12,200 as well. Coming to the contributors then in today's session, obviously banks, having a major hold in terms of some gains coming in from ICICI Bank, Kotak Mahindra Bank too. Infosys and L&T on the back of results, and the guidance that was maintained by the management upheld pretty well. What lost out was Reliance Industries, Z and TCS.
Okay, so some contribution coming back from the biggies today. But in terms of market breadth, the entire listed universe, I guess the market breadth has been looking good. I guess for the entire session, we sustained those gains. So clearly in favor of the advances. And also after 3 or 4 sessions, you had India Volatility Index, which corrected nearly 3% in trade. It's still at higher levels, but 15.7 should be good enough for the bulls if there is any sort of recovery to come by.
Turnover then, that's the final piece of the puzzle today. 43,000 crores in terms of the NSE cash market turnover. So this is definitely higher than what we've been seeing. Obviously, this is even for the F&O space, the usual number somewhere closer to 26, 27 lakh crores. This is much higher than that, almost 34.5 lakh crores in terms of the NSE F&O turnover as well. A quick closing comment from all our experts. I'll start off first with our technical guest. Amar Singh, I'll come to you first. What is it that you're going to watch out for tomorrow?
I would say that there's a possibility that we could see Nifty trading towards 12,250, 260 zone, because that's a crucial zone of resistance, and on the downside 12,100 is a crucial zone of support. So I would see that Nifty trading in this range tomorrow.
I don't know the number.
All right, Brijesh, what about you?
See, even as I have said, it looked positive right now until Nifty holds above 12,000 for the momentum to continue, and still the budget rally would be there. But overall, summing up, I would be only saying 12,000 is an important level, whereas on the higher side has been concerned 12,300 to 12,350 would be the hurdle to be crossed. So it looked like we might be trading in this range, whereas the very short term has been concerned for a day or two. It looked like we might try to touch 12,220 to 12,240 zone, where the trend decider, this level would be acting as a trend decider. So overall, it looked positive right now.
By the way, we'll just leave it at that. I just wanted to mark a few stocks which are now trading at fresh 52-week highs or life highs in the session today, and a clutch of them. I mean, when did the last you see a Godrej Properties have a 6% uptick in a single day? Watch out for that. There's Symphony, which is up 5%. So the broader end of the spectrum is looking very, very robust in the session today, and that's the highlight today. A very high turnover. I presume that a lot of this could be HNI stroke PMS activity in trade, because the cash market volumes also have looked very, very high.
We should see what the FI data throws up tomorrow, but I'm going to leave it at that. Thanks very much, Amar and Brijesh, for joining us. I think Neeraj got a bit excited looking at some of the stocks moving
it's
up.
It's great to see portfolios doing well, Devina. Trust me. I mean, the broader markets haven't done well for such a long time. It's good to see that going. Mayuresh, just one quick thought here. You reckon that some of these could do well? One investment idea maybe from you?
Yeah, so I think in the current context and assuming numbers expected to come through, I think GSPL is something that I still believe can do very, very well. I think the transmission volumes for GSPL should hold up very, very strongly this time round. And when I talk about the balance sheet dynamics, they've got a couple of SPVs that they're working with. So the stake sales that they've got in SPVs, even if I account for that and the assumptions that the volume activity there will continue at a very fast pace, the standalone business valuation itself on an FY21 basis should be anywhere around 225, 230 rupees a share, right? And that's on a very conservative scale. You toss that with a few of the SPVs, that couple of SPVs that I was talking about, you add another 8-10 rupees to that value. So you're actually talking about the core value on a conservative basis for the standalone business to be between 230 to 240 rupees. Now, I'm not even including Gujarat Gas and the 52% stake that they've got there. So phenomenal performance is expected with a lot of Morbi units opening up and a lot of gas supply coming on that side. So even if I take at the current market cap, the 52% with a 25 or even a 30% market cap discount or holding company discount, I think you still add a significant amount of value just on the base itself. So I think there is significant value unlock that can come through. And on basis of that, I think that remains one of our better picks, both from an earnings as well as a budget perspective, because if some announcements are made in lieu of gas distribution, gas consumption, I think GSPL can be a huge beneficiary both from a transmission and the consumption space as well.
All right, Mayuresh, we'll leave it at that. Thank you very much for joining us. And that's almost a wrap here on Countdown from Navneet, Neeraj, myself. But before we go, Chinese officials have officially locked down the city of Wuhan in order to stop the coronavirus from spreading further. They've halted public transport and have told a population of 11 million not to leave the city. China has also reported 8 more deaths, adding to the early morning total of 17. Selina Wang of Bloomberg News brings us the latest developments.
Some researchers say that number could actually be in the thousands. You have the second case confirmed in Macau. They are canceling Lunar New Year activities. It's now spread from the central area of Wuhan out to other parts of China, Southeast Asia, Japan, South Korea, the first case in the United States. So you have China now setting up this nationwide screening to try to catch cases of this virus, but it's of course being complicated as hundreds of millions of people have already started travel for Chinese New Year. And yes, you do have Wuhan essentially on this lockdown now, banning outbound travel by rail or flights, and they're also banning domestic travel. So the only real way for people to get out is by car, but they're really encouraging people not to leave the city. And I also want to point out that the detection issue is really challenging right now here in China, because we've learned that some of the deaths of people, they actually never even had a fever. And so temperature checking is the main way to monitor for this if someone's been infected. But if that is not an indicator, that certainly presents a big problem.
And what kind of, you've talked a little about what kind of reaction we're seeing there from the Chinese government. What about the response from international organizations? We wait to hear from the World Health Organization. They delayed their decision.
That's right. The World Health Organization has delayed their decision, saying that they need more information. It's a complex, evolving case. They don't have enough information yet to decide if this qualifies as a public international health emergency. If it does, they could issue some recommendations, including restricting some travel, restricting some trade. I do want to point out, give some little more detail around the Chinese government response. Yesterday, they had this press briefing, which was very detailed in terms of the control measures they're taking in terms of cooperation with these international organizations. China was praised early on for sharing the genetic sequencing of this case so that other countries could more quickly identify the cause of this. You also have netizens on social media that have been complaining about the lack of transparency here. So you do have government officials actually responding to that with the highest levels of government, from Xi Jinping, Premier Li Keqiang, saying that any cover-up of these cases, those officials will be severely reprimanded, and there needs to be constant communication. So the government has now set up this daily communication across the country, as well as more frequent communication with international organizations. So you do see a very high level of awareness and actually escalating fears, even here in Beijing, where you have officers monitoring temperatures, passing out masks. A lot of concern here.
Well, let's hope it resolves itself sooner rather than later. But on a very positive day for the Indian markets, it's a wrap on this leg of Countdown from Navneet, Devina and me, Neeraj, and the team that put this show together. Thanks so much for watching.